You're listening to Pre-Market Prep. I'm Brianna Valesky with my co-host Joel Elconin. We're joined by Nate Tobik. He's an investor and the founder of CompleteBankData.com. That's a place for information on banking institutions, and banking holding companies. Nate also runs OddballStocks.com, which is an investment blog that uses research from CompleteBankData.com. Nate, thanks for joining us in the heart of earnings seasons. How are you doing this morning?
I'm doing well. Thanks for having me on again.
Absolutely. So let's talk about these bank earnings. You made a very interesting point before we got on the live show. You said you've been seeing different types of earnings coming out of big banks, regional banks, and community banks. Can you expand on that a little bit for our audience?
Sure. I think the banking market could really be divided into the large super banks, which are banks such as Wells Fargo, Bank of America, Citibank. Then you have the regional banks like PNC, Regions, US Bancorp, and then all the smaller community banks, and there's thousands of these. And so what we've seen is that the largest banks are reporting incredible earnings numbers. And some of this is a tailwind from reduced litigation expense. So, for example, a year ago, Bank of America had a $4 billion charge against their earnings and for litigation. This quarter, it was only $175 million. So that's a huge weight off their shoulders, regarding their earnings. And so we've been seeing that the largest banks have incredible scale, and the scale's finally kicking in. Even with the lower rate environment, they've been able to push all the right buttons to get the non-banking businesses really firing. And so they're doing very well. And JP Morgan reported great earnings. Bank of America is really surprised a lot of people. They're doing what everyone expected them to do a couple years ago, and everything's on the right path now. But if you step down to the regional banks, the earnings story is a little different. Every regional bank I looked at was pretty much reporting flat earnings, and the flat earnings in some ways almost mask a little bit of a deterioration in their core banking business. So a bank like PNC, they've seen their net interest margin shrink dramatically over the past year. And what these regional banks have done is they've started to rely more heavily on things like investment management or other types of businesses for revenue that are going to fill the gap that the traditional banking revenue can't fill because of the decline in the rates and the rate pressure. And then the community banks, there's almost two groups in here as well. There's some that keep complaining about how terrible the rate environment is, and they just can't generate earnings to save their life. And then there's this other group, which is really, really great to watch. They figured out how to operate. And so you have a lot of banks that, community banks, that were mostly residential lenders. And they've realized that 100% residential lending is not the path forward in the future. And so they've expanded into commercial lending. They've expanded into other types of lending, and they've seen their earnings just explode. Some of these banks are also able to acquire other smaller banks, and there's some efficiency gains there. And it's really exciting to see what some of these community banks are doing. And there's a lot of growth in that area of the market. So right now it's kind of flat for the regionals. The large banks are really reporting great earnings. Although, you mentioned right before I came on, there are still some overhangs. So Citi had the $700 million fine for the credit cards, and that's a huge fine. And
Yeah.
that's enough to sink many of these smaller banks. And so I wouldn't be surprised if we continue to see litigation expense or fines like that trickle in over the next few years. But I think we're beyond the worst of that.
Don't you think, though, that it's not really true growth? I mean, the reason the earnings are looking better for some of these big banks is just kind of like just reduction in legal costs. It's not true generic growth. I mean, that could also be interpreted as a bad thing, that the only reason the numbers are looking better is because their legal expenses aren't as high. What about next quarter when, they're the same? Is there going to be any true growth in these big banks?
I agree, and that's a great point. The biggest banks are the most growth constrained because they need scale. I mean, how many new mortgages need to be originated every quarter for them to show growth? And the economy is just not at a point where where that sort of growth is coming, there isn't that growth engine to provide those numbers. So I think what happens with the big banks, though, is they essentially become utilities where they start to grow at a little bit above inflation. And just because of their scale, there's so much money coming in that they can't reinvest, that they end up paying out a lot of it in dividends and buying back shares. And they could have attractive yields. Some of these banks, if the litigation expense finally disappears and things normalize, a bank like JP Morgan might have, say, an 8% yield between buybacks and dividends. And that's a pretty good return just for sitting on a bank.
Nate, let's talk about some of the specific banks you're watching. What's at the top of your radar right now?
So as I mentioned, I like a lot of the community banks just because that's an exciting area. So one name that's really interesting is Summit Financial, and this is one way to play community banks. It's a recovering bank. So Summit Financial has a number of branches in the Shenandoah Valley, West Virginia, that coal country in West Virginia and Virginia there, and they were hit really hard by the crisis, and they have somewhere in the range of $50 million in foreclosed assets that they're trying to work off. And just to put that in perspective, their run rate net income is about $15 million. So they have a multiple of income sitting in these foreclosed assets, and the foreclosed charge-offs are really a weight on their income numbers as well. But they've been working these assets off, and as they work off, if they were able to reduce their foreclosed portfolio by, say, 50%, we'd see about a 18 or 20% increase to book value. If they got past these foreclosure problems, earnings might increase 16, 17%. So this is one of those banks where it's almost like shooting fish in a barrel, because you could see things are getting better. You could see the trend that they're working down this portfolio, and it's easy to just look forward in the future and say, if they continue to do what they've been doing, there's going to be a lot of benefits here. And so that's one way to play it. Another way is the growth angle, and a bank that's really representative of this is FS Bancorp, and that's FSBW. These guys are up in Seattle, and they've just grown like a weed. So they've grown their balance sheet by 37% over the past year, and deposits are up 24%. And this is true organic growth in their market area. They haven't acquired anyone. They've just been able to find that growth, and they've done it by focusing on a niche area of lending, and that's they lend to local home improvement professionals, and they have some sort of a loan product that they bundle. So say you need new doors on your house. This home improvement person would come by, they'd say, well, we have a way for you to finance the doors. The financing is done through FS Bancorp. Sometimes they are financing the actual materials for the home improvement person, and so that's a very short-term loan. Other times it's a little bit longer, maybe one of those 6 month same as cash type deals. And they've found this little niche, and they've done very well with it. And so they have an above average yield on their portfolio, and the growth is definitely there as well.
You mentioned one other to us before we got on the line, and I believe that was Sturgis. Can you tell us what sticks out to you about this bank?
Sure. This is Sturgis Bancorp is a smaller bank. They're located in Michigan. And so what's interesting about them is they're a great example of what happens when you could acquire another smaller bank. So they bought a bank, Western Michigan Bankshares, I believe, about a year ago. And that bank was not profitable, and it just could not turn a profit. And Sturgis bought the bank, integrated it, and turned it into essentially a branch location. And now it's pumping out earnings and cash for the company. So they applied their profitable process for running a bank to this unprofitable acquisition, and they were able to turn it around, and it took about a quarter. So there's a lot of opportunity for some of these small banks that are looking for some sort of a growth without having to find organic growth. They could find a rival in town that is not doing that well, and they purchase them at an attractive multiple, and then just turn on the earnings spigot.
Let's go over some of the other banks we've talked about on the show before with you. Fifth Third Bank, I think it's a FITB. Have you followed that at all lately?
I didn't have a chance to look at their numbers yet, so I have been, but I'm trying to work through all of them.
So let's talk about interest rates.
Yep.
I was just looking at a number, I want to say yesterday, that says there's an 80% chance we'll see a rate hike by December. I mean, I remember talking about it in January, and people are like, oh, we'll see one by June. Then it's like September, now December. And of course, there are people that say we can't raise them at all. Just get an update on your outlook on interest rates, and then maybe a brief overview of how this will affect those different groups of banks we were talking about: big banks, regional banks, and community banks.
Yeah, you know, this is just one speculation. Maybe in 2 years we'll be saying the same thing. Are they going to be going up in a couple months?
Right.
But I don't know. I think one data point that I always keep in mind is Bernanke had said that he doesn't expect rates to increase in his lifetime, and that's to normalize, not to increase, but to normalize back to
Right.
what they were pre-crisis. So maybe we get a rate increase, but it would be a small one. I think we need one at some point. The money is, so if you look, we're buying a house, and so going through the mortgage and just looking at the rates that are offered, and if you figure out the after tax value of the interest rate and then take out inflation, it's less than 1% is the cost of leverage to buy a house, and that's much lower than it's been historically, and that's very cheap. I mean, so if you took out, say, $100,000 mortgage and you have this less than 1% hurdle, if you had a way to take all that money, put it in your investment account, could you beat 1% a year? Yeah, you probably could. So it's very easy to get ahead, and the leverage is just too cheap. So we do need these higher rates, and banks need the higher rates. And so a lot of banks, they want a higher rate because they feel they can finally increase the rate on their loan book. But what I've seen is something interesting, and this is primarily with some of the smaller banks, is they're really benefiting from this prolonged period of low rates because they fund the majority of their business through CDs. And so if you had someone taking out a 5-year CD at, say, 2 or 3% back in 2010, that CD is finally rolling over, and it's going to be rolling over at a percent, maybe 1.2%, something right in there. And so for these banks that are primarily funded by certificates of deposit or by some sort of a time deposit, they're having this benefit now as rates have been so low so long, they've essentially waited them out, and now their customers are being forced into lower rate products, and that's really benefiting earnings because they're seeing some net interest margin growth, which is, I think that's something unexpected, and so that's for a lot of smaller banks that are really funding themselves through CDs. But when you get to the regional banks and the large banks, I think their benefit is really going to come from the rate increases when they could start to charge more on loans.
Nate, before we let you go, just want to get a take on some of the big banks here. We have some traders that are very active trading stocks like Bank America here. And man, this thing's got a quick move up to $18. I want you to put your technical hat on here. Look at Bank America up here at 18. Big run up here. I don't know. I mean, lofty level here, hasn't sold off with the market yet. What's your thoughts on Bank America at $18?
I think it's still an attractive buy. What really sticks out to me when I look at their chart, though, is you see these dramatic drops right before earnings come out, where it's as if investors are getting so scared they don't know is there going to be a surprise, what's going to happen, and then the bank reports better than expected earnings, and the stock shoots right up again. And so, for a trader, it might be worth playing the earnings Uh, you know, this goes back for I could see the last year at least,
Mm-hmm.
and people are just they're very very hesitant, and it's for the banking sector. If you look at the KBW Bank Index, it's the same thing. There's these sharp drops right before earnings are released, and then it bounces right back up, and these are quick. They're quick runs.
Okay, one more for you. J.P. Morgan here. Once again, nice run up here after earnings. Kind of not giving away with the market here. Just a technical look at J.P. Morgan.
Yeah, JP Morgan, they're really firing on all cylinders, and they're doing very well. I think JP Morgan, if you look at them, it's they drop and then they bounce back, but it seems like each time they kind of bounce back higher. So I would say, this one's a decent stock to hold on to for a while. And so this is just one thing I had seen recently. For everyone who's talking about how bad the banking environment is, Jamie Dimon recently became a billionaire, basically from running this bank. So it's clearly not that bad of an environment.
Yeah,
And
just think what
yeah,
just think where the stock would be if they didn't have the whale trade, huh? This thing would be it'd be in triple
abs-
digits. We
absolutely,
We've been on the
absolutely.
line with Nate Tobik. He's an investor and founder of CompleteBankData.com. He has information on banks, banking institutions, bank holding companies. He's a value investor and also runs OddballStocks.com, an investment blog that uses the research on the banking sector. Nate, great information as always, and I know we mentioned this before. We're going to get him on with Tim Melvin sometime
Oh,
and have
yeah.
a little banking discussion. Thanks a lot, Nate. Have a good day. We'll talk to you again soon.
Thanks, Nate.
All right, thanks for having me.